Hello, everybody. Thank you very much for joining me today. Well, it's October 2nd. And again, I've been commenting on how time flies. It seems that this year has flown by us a lot faster than previous years, at least from my perspective. Maybe it's because there's never a dull moment in our business. There's always something interesting, exciting, depressing. It's been a real roller coaster ride for some time now, and really since COVID. And now the question is, where are we going from here? And odds are we're going to continue to see this kind of roller coaster ride, but we remain fundamentally bullish on things. Before I turn to that, let me turn to the weather. We have a beautiful day here. We had some real rainstorms, a little flooding in the basement, not too badly a few days ago, but the next few days promise to be in the 70s, maybe even get up to the low 80s. So we're looking forward to some nice weather here. And again, as always, I hope it's nice where you folks are. I should also point out, as I usually do, that Max is joining us, and Max sleeps very soundly during my web chats here with you folks. So let's, if you see him kind of walking around, he doesn't do that too often at this time of the day. Somebody told me that the nice things about King Charles Cavaliers is they're couch potato dogs. They don't do much. Which some people want more active dogs, but one of my relatives has a sheepdog that wants to play all the time. It's very active, very hyper. So we like this breed for their calm demeanor. They always calm me down. Well, I try to calm you folks down. I can't say that I'm always successful, or that I myself am always calm about things. I try to be realistic without getting too emotional about the ups and downs of the markets. Well, let's see if we can do that today, thinking about the week ahead, the month ahead, the end of the year, and going into next year and to infinity and beyond. Well, let me start off with asking you a question. Do you want the good news first or the bad news first? I'll start off with the good news. I won't let you answer that. This week's morning briefing, Monday's morning briefing, I should say, since we write daily, Monday's morning briefing did focus on some good news. I thought you all could use it. Market's been down since July 31st. It's not something that is a total surprise to us. We were thinking that since we got to 4,600 basically by the end of July 31st, ahead of schedule, instead of the end of the year, we figured the market would be less exciting to the upside during the second half of the year. And then along the way, we looked at some charts and concluded, there's a chance we'll be going down to the 200-day moving average, which is around 4,200. And we're clearly not that far off from that level. Hopefully, that 4,200 level will hold. And I think there's actually some good news coming here, most importantly for us on the earnings front. In the quick takes that we sent this morning, I pointed out that the outlook for earnings is actually pretty good in the third and the fourth quarter. Joe Abbott brought this to my attention that based on what he's seeing from the numbers he's looking at analyst expectations, and remember, analysts tend to be a little bit too pessimistic going into earnings season, and there is an earnings season coming here this month going into November. And we will not be surprised at all if S&P 500 earnings per share hit an all-time record high in the third quarter. And if that doesn't happen, then I'll tell you it's going to happen in the fourth quarter. The bottom line is in the third or the fourth quarter of this year, the actual, not forward, the actual quarterly S&P 500 earnings should be at a record high. And I think that the third quarter season is going to go off pretty well. I think there are going to be a lot of upside surprises. Now, why could that possibly happen? Well, a couple of reasons. One is real GDP was pretty good in the third quarter. It looks like it's coming in somewhere between 4 to 5%. Take your pick. I know some people are trying to be conservative relative to the Atlanta Fed's projections, but 4 to 5% right now is what the Atlanta Fed's projections are for the third quarter numbers. So better than expected, real economic growth. That should translate into better than expected revenues. Of course, we've had strong revenues all along here. We haven't had a profits recession over the past few quarters, a mild one, as a result of revenues. Revenues have continued to go higher, and a lot of that is because price inflation has boosted revenues, but even adjusted for inflation, real revenues have been doing all right. They've been on the up and up, on the uptrend. But the profit margin has been eroding for the past few quarters. And yet we think that it probably bottomed in the first half of the year, which would be quite remarkable, because that would be a much higher bottom than we had with the great virus crisis or the great financial crisis. So the erosion in the profit margin hasn't been all that severe, as costs have increased faster than prices. But now we're seeing that analyst consensus expectations for the profit margin, based on their expectations for forward earnings and forward revenues. Remember, we have that data on a weekly basis, and the forward profit margin, as we'll see in a second, tracks pretty well the actual quarterly profit margin. So there's some evidence here that should get some pretty strong revenues number in the third quarter, combined with an improving profit margin, and that could very well get us to an all-time high in S&P 500 earnings per share. Again, take a look at the quick takes we sent this morning. I was going to show it to you on the screen, but you know me, I mess something up almost every time I do this, so I just wanted to focus on staying with the program, which is to focus on the charts. As I was saying that, I thought I lost my mouse. Oh my God, my mouse is gone. All right, let's have a look here. So let's go to the charts. Share my screen here with you folks. If everything works out right. Okay, here we go. You should be looking at chart collection for morning briefing. Today is October 2nd. So everything is right with the world so far. Well, I got some good news, I think, on productivity. I hope I'm not making this up, but I think there's some evidence that productivity is making a comeback. And as you can see here, this is the productivity numbers in the red. And we've looked at this chart before. It shows you the 20% change at an annual rate in productivity. So that's the red line. We had a boom here, productivity growth boom here, 3.5%, 4%. We had a productivity growth boom here in the 1960s, so the 50s, the 60s, we got up to 4.5%. Then the great inflation was exacerbated, and might have been the underlying cause might have actually been a collapse in productivity from 4.5% growth to virtually zero. Then we had a little Reagan bounce here in productivity that kind of fizzled. Then we had the PC, the Intel, Microsoft productivity boom. But as I've said before, that productivity boom didn't lend itself to a lot of companies to share in using the technologies. Basically, we had these very clunky boxes on our desks that could do Excel and could do Word. So that replaced Selectric typewriters and maybe replaced a lot of bookkeepers. But most companies didn't really benefit that much from the tech revolution back here. And so things kind of fizzled out after we produced and sold a lot of boxes and a lot of software. So a lot of that productivity boom was not so much computers creating more productivity for other companies, but simply creating more productivity because more people were buying those boxes that boosted real GDP. So then that kind of fizzled out, as you can see, and we got down to 0.4% at the end of 2015. And then lo and behold, it looks like things are starting to improve. And we go from 0.4 to, I think this was like 1.6% right before the pandemic. The pandemic screws everything up. But now we're back to 1.6% for the, and this is the 5-year trailing. So that's pretty good. 5-year trailing productivity at 1.6%. Now here's where I get delusional, or at least far-fetched. And that is talking about productivity going to 3.5 to 4.5%. Sounds wild unless you unless I show you the chart to show you that it's not that delusional. It happened back here. It happened in the red line. It happened here, and it happened there. So at this time, the technology revolution is much more applicable to every business model, leading me to the conclusion that all companies, really, in theory, should be viewed as technology companies. I know that this sounds like I'm saying this time it's different. That we should now think of all stocks as technology stocks. Therefore, they deserve a higher valuation multiple. But if you need an argument like that, there it is for you. On the other hand, it might be a jinx, so you could use it the other way. Here's productivity growth again, the very same chart, this time in baby blue, or just blue. Here's the baby blue is the great inflation, and you can see the collapse in productivity here, and you can see more clearly what's going on here and our projections out there. So what am I getting excited about here that suggests that productivity may be making a comeback? Well, we look at real average hourly earnings as this chart showed. Productivity growth and real hourly compensation seem to be tied at the hip, which makes sense. Real wages, real productivity are tied to real productivity, to actual productivity. And you can see that relationship is pretty good. Here we're looking at just the monthly data. The real compensation is only available on a quarterly basis, and I get impatient. I like to see things a little bit sooner than that. So here you can see average hourly earnings divided by the consumption deflator, including food and energy, which by all rights it shouldn't include food and energy, but it does. And maybe over time these food and energy average out. They do tend to be volatile. But the bottom line is that for all the talk about stagnation of wages, real wages have actually been increasing since the mid 1990s. And they've been increasing at a reasonable rate of 1.2% per year on this trend line. And it's not a straight shot up. Here, productivity, this I think is a proxy for productivity. I don't think real wages can go up without productivity going up. But here you can see during the pandemic, real wages stagnated. And now if you take a magnifying glass, you can see that real wages are crawling back up along that 1.2% trend line. So if productivity stagnated or got hit by the quits and all that back here, it looks as though things are starting to normalize and real wages are starting to improve. In my story, of course, I would expect that the real wages would increase faster than this trend line of 1.2%. Now, again, if you take a magnifying glass, you'll observe that August was actually down a tad. But that's, again, using the PCED with food and energy. It doesn't really change my view. I'm looking at the trend of the past few months, and I'm encouraged by that. Another encouraging development, as I mentioned in the intro here, is the profit margin. And as you can see, the profit margin peaked back here just around 13.5 for the S&P 500. You'll notice that it got down here around 11.5. I'm thinking that this was the low in the profit margin cycle, which is well above what we saw back here during the GVC and here during the GFC. I think everything since the GFC, companies have been laser focused on increasing their profit margin, or at least maintaining it. That seems to be a clear message from what I'm seeing in the way companies are being run and managed. Most important variable is the profit margin. And they've done a pretty good job of increasing it. I mean, the Trump tax cuts obviously helped here. But here we are at a record high and coming down. And now I think we're bottoming. Why do I think we're bottoming? Well, the analysts are telling me so. This is the analyst consensus expectations for the profit margin. There is no such thing. We have to calculate it by using analysts' forward earnings divided by forward revenues. And as you can see, we were experiencing a profit margin recession, and that seems to have bottomed out as companies have figured out how to deal with costs. And one of the ways you deal with costs is increased productivity. Meanwhile, while we're talking on good news, I think most of the charts are good news. So my conclusion is going to include some reasons to worry. But the private non-residential fixed investment was updated again with real GDP last week. We have a component there called manufacturing structures. And look at that, just going straight up. So that's clearly a sign of onshoring. Government's incentives to onshore are contributing to this development. Of course, the pandemic heightened interest in onshoring, and then geopolitical tensions between the United States or between China and the West have also led to a tremendous incentive to onshore. That, of course, has been very positive for construction orders. You can see construction orders, the blue line, all-time record high. When you look at the trend, they can be volatile. This is the orders is the red line, the shipments are the blue line. So that's good news. And because of all this construction going on, construction employment is at an all-time record high. So that doesn't happen in a recession. Usually it, as you can see in the past, has peaked at or prior to recessions. We do have a recession in single-family housing starts, but multifamily has been holding up pretty well. By the way, this is another component of construction employment. And you can see that heavy and civil engineering construction, all-time record high. More than offsetting any weakness that we're seeing in anything related to residential. But residential isn't that weak because the weakness is concentrated in housing starts. And meanwhile, multifamily has been very strong up until August. August, we saw a big drop in multifamily housing starts. This is the real GDP component of that. And could be a fluke. Then again, it's quite possible that the math no longer works for developing new multifamily units. Why is that? Well, we know that rent inflation's come down like a stone based on the Zillow index and the apartment list index. And we know that commercial mortgage rates have soared. And most of this building has been going on in the South and West. And I'm told that there's starting to be a glut of these multifamily units that are being built. So that may very well be coming down. That's mixed news. It's not so good for the economy. But the good news is that if this reflects the fact that rent inflation has been coming down substantially, then that's just more confirmation of that. We should see that increasingly in the CPI and the PCED, that the rent inflation component comes tumbling down in the next 3, 6, 12 months over that period. And that offsets whatever inflationary pressures we still have in core services, excluding housing, which we think will come down too, because we think wage inflation will continue to moderate. This, by the way, is single family. What's the good news there? I think we're bottoming out. There's a real shortage of housing. There's a real shortage of existing homes, and people are getting used to mortgage rates. They got used to 7%. Maybe they're about to get used to 7.5%. And there's a demand for housing, and the home builders have found a market. Sometimes they have to figure out ways to discount the price one way or another by maybe throwing in some extras. But all in all, this is encouraging. Another encouraging development, which was updated in the GDP news last week, is inventories. And you can see that we had a real inventory, let me see if I can get a couple of these panels on here. I wanted to get, this is total inventory investment, this is manufacturing, and this is wholesale and retail excluding autos. And as you can see, there was a real pileup of inventories here, mostly at wholesale and retail. We've talked about this before. My family and your family and everybody else went on a buying binge after the lockdowns. We needed to get some dopamine released in our brains to make us feel better. And so we went shopping. We couldn't buy services very much because there were social distancing regulations in restaurants and airlines, and all sorts of restrictions about flying to places and coming back home. But as those restrictions got lifted, the buying binge dissipated for goods, and they got and meanwhile the wholesalers and retailers ordered a whole bunch of stuff, and that all piled up over here. And now we're seeing that they've actually been able to liquidate some of that. How did they do that? Well, they lowered prices, which has contributed to our story on disinflation, at least on the good side for sure. This is just manufacturing and trade inventories. There's been a rolling recession in the goods sector, and you can see that in inventories. This is the total manufacturing trade inventories, so that's gone absolutely flat. And that may explain some of the weakness in CNI loans. The pessimists are jumping at it saying, this proves that we got a credit crunch and banks aren't lending. But the demand for credit may be weak, not because the economy is weak overall, but because we've got a recession in the goods sector. And then today's PMI report, manufacturing PMI, suggests that it's not over, but it looks like we may very well be bottoming. By the way, that PMI report also showed a drop in the price index, which we of course welcome given our scenario. Good news, but this is kind of mixed news. We had a GDP report that included the profits data for pre-tax and after-tax profits, and as you can see that they declined. But when we translate this to corporate cash flow, you can see that corporate cash flow has edged back up in this. Let me see if I can give you a little magnifying glass for that. Yeah, it just to prove it to you, edged back up to to its previous record high. And so the corporations at an annual rate are generating $3.2 trillion of cash flow. They're generating liquidity. They're not all that dependent on borrowing money even on a short-term basis to make ends meet. There's plenty of cash flow. How about inflation? Well, we had the PCED inflation rate come out, and as you can see, the headline rate was 2.8%, excluding rent. Let's leave out rent. I mean, we all know that it's a faulty indicator of current rent inflation. We know that rent inflation is coming down. And so it's important to look at it ex rent. And so the core PCD excluding rent is 3.2%. Continuation of moderation, in my opinion, a little uptick here, but not to worry. Things don't go in a straight line in life, as we know. Speaking of that, this has been the issue here. The non-housing services PCD continues to be stuck around 4.5%. Meanwhile, the orders, the goods component of PCED inflation rate has come down dramatically. The durables is actually slightly deflating. This is the uptick in energy prices. By the way, we're looking for energy to stay. We don't think it can sustainably go to 100 to 120. Even the Saudis recognizes that would probably cause a global recession. So we're the opinion that the price of oil is probably peaking around here. If that's the case, that'll help our story quite a bit, because if it goes to 100 to 120, you do have that risk that it creates a wage price spiral again, and a rent spiral, and kind of a repeat of the 1970s all over again. By the way, before we looked at manufacturing and trade sales of goods, you can see here, and we looked at their inventories actually. Here you can see their deflators, and across the board, manufacturing, wholesale, retail, they've all had to cut their prices in order to clear their inventories, and that's what happens during recessions, and that's what's happening during the current recession. Not economy-wide recession, but rolling recession in the goods sector. Meanwhile, I think we've all been amazed by the strength of consumer spending during the third quarter. It looks like it came in at something like 3.5%, 4.5%, but it looks like it slowed down in August. It was up. Consumer spending was up only 0.1% month over month during August, and that's with a 0.2% increase in consumption of services and a 0.2% decrease in goods. Goods, of course, is a smaller component of consumption than is services. So here's again that story I was pointing out, is just because CNI loans are turning over doesn't mean that's signaling a economy-wide recession. It's just confirming that goods inventories, which is what they always are, have been flat, and there's just less need to finance them, and there's plenty of cash flow. So what's the bad news? The bad news is the bond market, and I coined the phrase Bond Vigilantes back in 1983, and they're on the march again. There's not only have they saddled up, but they're on the move. What are they upset about? Are they upset about monetary policy? Well, historically speaking, the bond market likes it when the Fed gets very restrictive. That's when you get the inverted yield curve. That's when bond yields stop going up as rapidly as short-term rates. And there's a great opportunity to buy bonds when the yield curve inverts, because inverted yield curves have had a good track record of signaling that something will break in the financial system, which then causes a credit crunch, then causes a recession, yada, yada, yada. You've heard the story from me before. Well, where are we now? Well, we had a crisis. Yield curve worked. The banking crisis in March happened, but the Fed came in pretty aggressively. I guess if the bond market is concerned at all about what the Fed's doing, it's certainly not. I don't think it's on the inflation front. I think it's on the QT side. We have what the bond market's really concerned about, what the bond vigilantes are concerned about, is profligate fiscal policy. And the Fed isn't helping because the Fed, instead of holding on to the bonds that were purchased during the periods of QE, the Fed is actually letting those bonds mature. And so in some ways, the consolidated deficit of the government, if you include the Treasury and the Fed, is what can I say, but huge. And so I think what we're seeing here is the bond vigilantes protesting profligate fiscal policy, recognizing that the Fed is selling or letting mature its bond portfolio. By the way, that's not really that accurate. But I should be more exact here. We do have weekly data on what the Fed's holding onto, and the Fed's actually holding on to its bonds. It's its short-term securities that it's selling off. But maybe there's a misperception here that look what is clear is the Fed's not buying bonds. Okay, that's really what's clear. And meanwhile, because the Fed's not doing QE and doing QT, that's having an impact on banks, and banks have seen their deposits weaken. And so to offset that, they've let their fixed income securities mature. So they're not buying bonds. So it's all up to the household sector. It's all up to foreign investors. It's all up to institutional investors to support the bond market, and they will. The only question is at what rate. And the bond market's answering that for us on a daily basis. It wasn't 4.25%. Looks like it's not 4.5%. Now we're working on 4.6, 4.7. The way things are going, Ackman may very well get his 5.5% on the 30-year bond, and that's all has to be of concern. It's not only terrible for bond investors, but it's amazing how well the stock market's held up in the face of the TIPS yield jumping up over 2%. The nominal yield rising over 4.5%. I think the explanation is that the market is actually getting pretty good vibes about earnings, and maybe that's helping to keep the market up here. Also, the market may simply concluding that the economy can withstand these kind of bond yields. I mean, everybody's talking about the Fed no longer raising interest rates. Maybe one more time, but meanwhile they're still doing QT, and QT is still monetary tightening, and it's having an impact in tightening through the bond market, and that probably matters more than short-term rates when it comes to commercial mortgages, commercial rates, and we know that the commercial real estate market is in the early stages of a rolling recession. It could become something worse, but I'm still sticking with my rolling recession paradigm. Still sticking with 75% subjective probability that this thing will continue to be a rolling recession with rolling recoveries, adding up to a soft landing. 25% odds of a hard landing. But I have to tell you, I'm very concerned about what I'm seeing in the bond market. That's not good, and it may very well be that the bond vigilantes are shouting to the fiscal authorities, no mas, no more. You got to do something about these out of control deficits. So never a dull moment in this business, as I said before. Let's take a couple of quick questions here. There's a lot to talk about, so I cut into our Q&A quality time here. Let me start off with Chip, who's kind enough to tell me the video and audio are working. With the less than desirable fiscal deficit, that is rising outlays, decreasing tax revenues, what's the market downtown downturn risk, I think you meant, if the TCJA corporate tax cut sunsets. Well, yeah, I think at the end of the day, what the bond vigilantes want is they want uh, out, outlays to be cut, and they want tax revenues to be increased. And as we just saw, there really isn't a will at all to do that in Washington. Maybe one of the reasons the bond market's selling off this morning is because shucks, the government didn't shut down. Wouldn't it be great if they just shut the thing down? At least that's the bond vigilantes' perspective on these things. Um, Denise, Ed, the outlook for earnings looks constructive as you described. What about banks? Do you think this quick rise in 10-year will cut their earnings and or set up some bank failures? Yeah, I think that's exactly the risk in the financials is that, I mean, as we all know, they kind of divvy up their portfolio into held to maturity and then held for trading purposes or not held to maturity. So the ones that are held to maturity, they can just kind of whistle in the dark and say, you know, we're just going to hold these until they mature and we'll get our money back. Meanwhile, they will have missed on some great opportunities to get better returns on their portfolios. But there could be more significant losses in other areas. And I think certainly in commercial mortgages, there could be an issue. I'm watching the bank data on a weekly basis, and there is a couple of series for all banks, small banks, and large banks on provisions for loan losses, and they're increasing, but they're not soaring. And I think these things have to be reported fairly accurately. So we aren't seeing a real calamity at this point in that area, but clearly it raises fears of that issue. And of course, the SMID cap banks have not fared well. Let's see. Let's see. What's your take on oil? This is Ian. What's your take on oil above $100 per barrel? If the expectation is a recession, counterintuitive, and well, it's a long question here, but you know, the basic message is the one I gave before: is you know, oil could spike to 100 to 120, but as was pointed out, has been pointed out recently by recession forecasters, recessions have usually been preceded by spikes in interest rates and spikes in the price of oil. And we got both of them right now. And I can't, I mean, the Saudis have this vision 2030 that requires oil to be around 100. But just because it requires it doesn't mean they're going to get it. And they got to be realistic, because if they charge too much, they'll get demand destruction. People will drive less, and they'll get more competition from non-OPEC sources. So I don't think 100 to 120 is sustainable. I mean, if it were to get there, it could very well, I may very well have to increase the odds of a recession, or it may not stay there for very long, as the Saudis recognize that they've got to pump more. Take a couple more. Real wage trend line is 1.2%, but real wages as a percent of real GDP is down over the same period. That's a good question. It's a good observation. It's also kind of complicated. Compensation, there's something called proprietor's income, which is basically the income that people like myself pay ourselves in our small businesses. And there's a lot of proprietary income out there that's not included in compensation. Maybe I'm not viewed as a working stiff, but sure feels like it when I do what I do. So it's kind of complicated. I wrote about it in my book, Profits. In Praise of Profits. You can barely see the title behind me, but there's some discussion of it there, and it's available as a PDF file on our website for those who are subscribers. Well, I'm overrunning my time here. I noticed you have GPT bookmarked on your browser. How often do you use it? I'm glad you asked me that. So far, it's been pretty much useless. It just makes mistakes all the time. You know, it's just a statistical model that just kind of says, on average, this word should follow this word. And I've asked it all sorts of questions. At the end of the day, I keep going back to Google, the old-fashioned Google, and look for the original sources. and write it up all by myself. So for me, it hasn't done much of anything. Oh, quick question here from Joel. Do you think this inflation is structural? No, if you've been following my work, I think it's turning out to be transitory after all. I think I'm going to have to cut it off there. I apologize for that. I guess I got too long-winded today. I guess usually I am too long-winded. But look, have a good week. This is probably going to continue to be somewhat trying, but I think October may not be a great month, but I think it'll set us up for a year-end rally. And what will drive the year? Well, I said it may not be a great month. It could be a very good month if we get a lot of positive earnings surprises and the bond market just kind of holds its horses. The bond vigilantes hold their horses somewhere between 4.5% and 5%. Looks like the stock market can live with it because the perception is that the economy can live with it. Well, happy trails, everybody. Have a good week, and we'll see you next week.